Digital Asset Group, which is an offshore arm of Vanshell Blockchain in Shanghai. So we work out in Hong Kong. I spent about 25 years in investment banking industry, trading foreign exchange, and fixed income products.
And for those of you who don't know me, my name is Ran Neuner, or you may know me as Crypto Man Ran. I run the world's only televised cryptocurrency show on CNBC. It's called Crypto Trader. I also run a fund and I run an accelerator program in New York City. This Bitcoin bull run, and I say Bitcoin bull run because it really is a Bitcoin bull run. Is it the institutions coming to play? Rich, I'm looking at you because you'd be the funnel for the institutions.
I think it probably depends on your definition of institutions. I think that if you count the suppliers, the miners, they're also institutions. I think one of the main drivers of this last few thousand has been that the miners aren't really selling, they're holding, they're borrowing money to produce more for the future, so it's helping the rally in the short term. I'd say that it's a mix. There's no smoking gun on that demand side. There's certainly retail participation, so it's not 100% institutions. But I think there's more institutional buying now than ever. As we have the custody in line, we have more institutional exchanges that are getting ramped up. So I'd say that one of the main drivers is institutional.
So I hear you when you talk about the custody being more in line, and it definitely is more in line than it was in the previous bull run. But let's look at the previous bull run, 2017 bull run. Let's agree that that bull run was 90% retail money, and probably 10% what we call institutions. Be institutions, VC companies, funds, etc., etc. This bull run, what does the 90% become and what does the 10% become? In other words, how much more institutional buying is there by virtue of the fact that all these things are now in place? I'm willing to open that question to you guys.
I'm happy to jump in here. I think this bull run in 2019, it's not just the institutions, but we also have to look at the overall macro story. Global central banks, be it Fed or ECBs or BOJ, even PBOC, sort of going back to the easy sort of a policy stance as well as starting a QE. So I think that's very similar to what we saw back in 2017, where the markets were pretty much in a Goldilocks scenario, where all asset classes go up, all prices go up. That could be one of the reasons, part of the reasons that this bull run in 2019 that's so far has sustained itself. Now, the second half of the year, we don't know what the policy stance is going to be. I'm hoping it will continue to be that. Bitcoin prices will continue to go up. When you say institutions, I think the other parts of the answer to your question, really, when you say institutions, I think if you define that as endowment funds, hedge funds, family office, etc., we do see an inflow in 2019, a very strong inflow, by the way, into these funds. So capital, investment capital is going to venture capital firms, and the risk capital is going to hedge funds and endowment funds and the hedge funds. So I think, yes, the answer is, to me, institutional players in 2019 really stepped up. If you look at some other indications, one of them is CME's futures open interest. That's gone up quite a bit. There are accounts that are into CME to trade futures, and those account numbers have gone up as well. These are solid indications of institutional players in the market. CME account holders are all institutions like us. So I would say, to your question, yes, that's a very clear sign that institutional influences in 2019 markets are very strong.
Chris, what do you think? Is this institutional buying pressure as Colin defines institutions, or is this still the retail investor buying from his Coinbase account or his Binance account?
Yeah, I think it's really important to delineate crypto institutions versus traditional Wall Street institutions, because I think the crypto institutional buyer was purchasing throughout the entire bear market. And to Rich's point, I think right now it's a little bit more of seller's exhaustion. People have accumulated and the sellers just aren't wanting to sell, whether it be a variety of reasons. If you believe that Bitcoin's digital gold, all the QE that's happening throughout the world, that would bode favorably for Bitcoin as an asset class as well in that specific situation. So I think relative to 2017, long answer short, in 2017 there were hardly to no actual Wall Street institutions that were touching this, and it's pretty impossible to go lower than zero. So I would say that, yeah, people are kicking tires on it, but in terms of widespread adoption, there's a lot of headwinds that they're facing, whether it be custody, regulatory, et cetera, et cetera.
You know, I always say that CNBC is a good barometer for what the institutions are doing, the retail investors and the institutions. Now, if you remember in 2017, CNBC started to introduce crypto to the show called Fast Money and maybe Squawk Box, and they started off by having one segment every now and then. Then they went to one segment every show. So there was a Bitcoin or a crypto narrative, one in every show, which meant about 10 minutes of every 60 minutes. Today, every single CNBC show, options, futures, fast money, Squawk Box, every single one of them is overweight towards Bitcoin. And the question is whether that is going to filter down to the institutions to say, look, if you watch the media is talking about this very much overweight. Are you going to start moving, are institutions going to start moving their portfolios much more into that because of the journalism? What do you think?
I think hype can always help grow awareness. Is what people are focused on. But as far as will the institutions follow the hype? One of the institutions I know something about is Goldman Sachs, where I was for a dozen years prior to GSR. I think there's this construct that it's more about their philosophy and whether they like Bitcoin or whether they're bullish Bitcoin. Meanwhile, it's more just a business decision whether the market's big enough. There is some, is it on brand to be involved? I think the bigger decision is how big is the market? And if it's a $50 billion market like it was towards the lows a few months ago, it doesn't make sense to replan the company and enter, because that's not even a bigger stock. But once we get to the few hundred billion or half a trillion, which we're closer to now for the industry at large, then I think you start to put more of your resources towards it. So it's less of an emotional response, and it's more just a business decision.
Let's talk about the reasons why institutions would claim that they wouldn't get into Bitcoin. The most obvious one is that, Bitcoin is a Ponzi, it doesn't really work, it's tulips. I think that excuse is out of the way. Can we agree that now Bitcoin is actually a real asset, and institutions are starting to look at this and go, actually that's not drug dealers' money, actually that's not a tulip thing, this thing may be real. Are we comfortable that we're past that stage?
Has Warren Buffett had his lunch yet with the crypto team?
I hope that the one thing that comes out of that lunch is that he buys Bitcoin and doesn't land up buying Tron or anything like that. So we can agree that asset managers today or institutions today actually see this as a real asset class. Okay. Do you think that we've solved the custody problem to a good enough, is the custody solution in a good enough place that the big institutions can say, we're comfortable that we have a real custody solution?
I'd say not quite.
Not quite.
If you look at the custody landscape in terms of where it's at right now, to be a qualified custodian, which is what the large asset managers require, there's two options with which you can do it. You can either go through the state trust process, which is what we've seen through whether the South Dakota, Nevada, New York trusts, or you could go through FINRA and the SEC in that process there. And so I think in order to become comfortable, a large buttoned-up Wall Street institution is going to want to see the likes of a Fidelity or a State Street or a household name attached to that custody solution, and most likely via the channels that they're more familiar with, which would be the more of the FINRA and the SEC route, and slightly less through the statutory trust. So I think if we are talking purely on the institutionalization of Bitcoin, I do believe that that's a headwind for that aspect, but I do believe that relative to 2017, the custody solutions, the insurance provided, and everything under the umbrella of custody right now is light years ahead of where it was.
I want to separate custody and insurance. So what you're saying, from a custody point of view, you don't believe that we've fully checked that box yet?
In terms of the topic of institutionalization and whether or not Wall Street firms want to rush into this market, I would guess that there is some apprehension around these state trusts and the way that they're operating.
Colin, I see you nodding. Have you checked that box?
Yeah, so I kind of agree with Chris. I think, we made big progress in 2019. 2-3 years ago, you probably only had, 2 or 3 names. It's relatively unknown. It's regulated name, custody names, but relatively unknown. Today, we probably have 4 or 5. I can remember Bitcoin, custody, Coinbase offers that, Fidelity offers that. So by the end of this year, you're probably looking at 7, 8, 9. It's a big improvement. At the same time, these crypto assets are being not just regulated, they are, I know you said you didn't want to separate the insurance, but they are insured. The crypto assets are insured, right? By ING, by Allianz, by, what's the other one, Lloyds. So I think we made very big progress. Now, exactly enough to satisfy large institutions' needs. I think, again, we're going back to the definition. Do we consider the banks large institutions? Of course they are, but are they going to be satisfied? It's probably not. But if you look at the other buy-side firms, endowments, hedge funds, and small hedge funds, and some of the family offices, so I think that probably, conditions are met.
It's hard to define institutionalization. It's something that's truly global. When institutionalization of one jurisdiction could mean something and different, and the rules and regulations associated with it mean very different things.
Yeah, I think for the purposes of this discussion, we should probably take the middle ground, because then we could philosophize for hours around what institutionalization is. All right, so custody, we're lukewarm on custody. Trading solutions. Is there an institutional grade trading platform that we believe that institutions are comfortable with today?
GSR, we spent the past 6 years building one, and there's a whole host of institutions that we trade with daily that trust what we've built. But I think that there's another 2 dozen out there. There's third-party solutions that you can outsource or whitelist. Everything's evolving in the same way, as you can mention on custody. There's some solutions that take 2 days for you to get out of cold storage, but I think it's going to be better if in a year it can take a matter of minutes. I think on the trading side, we're decades behind where trading is in traditional space, but within a couple of years, I think we could already be close to being on par. So there's fast evolution happening today.
So the way I like to look at institutional investing is I always imagine the guy who's standing in front of the pension fund investment committee, and he has to answer as to why he did something after the fact. So, what do you mean? You mean you bought this digital asset that you weren't even holding and it disappeared, got hacked? So this is the framework for the question. The question is, could he defend himself that there are enough institutional grade trading platforms out there to justify buying the asset? And I think what you're saying is the answer is yes, but they're not as sophisticated as traditional trading systems.
I think no matter how much someone purports that they have a good system, unless you see it in work, you don't know how good it is. And ours in 6 years haven't had any issues, haven't had any tokens hacked or stolen or missing. So I think there's some new solutions, but until they're tried and tested, it won't be as clear that they're functioning.
Okay, Chris, any comments on the trading platforms? I mean, do you think that the institutions are ready to use the platforms that are out there?
It's interesting. I've been talking to more people that have provided traditional technology in the markets that are starting to kick tires on the crypto. So I think, yes, I think the OTC desks are the way to go right now, the relationships associated with it. They know the liquidity and the market dynamics better than anyone else. And I've been amazed over the past year, the speed with which derivatives and structured products and more sophisticated institutional type instruments have entered the marketplace and gained a lot of attraction and popularity, which gives that pension fund manager a little bit of optionality with which they can use to hedge their position if they want to take a more cautious approach.
So I guess trading solutions, there are two things, right? One is on the exchange side. When we talk about trading solutions, we really talk about technology. So on the exchange side, I think the exchange technology, they all really that great, right? I'm sure all of us have that experience with all the exchanges. The speed is slow, the data is really million out there. I think in terms of the speed, the scale, and the stability, exchange technology really needs to upgrade. Now, if you're talking about trading solutions for buy-side firms or OTC firms, market makers, etc., HashKey is literally just started 2 months ago. And we're right in the middle of hiring devs and writing applications, writing trading platforms, etc. Coming from a foreign exchange background, one thing I noticed is that all of the trading solutions we have, I think the technology was 30, 40 years old, we can still transpose them into the crypto world and use that as a starting point. And you got to tweak and you got to make adjustments, but at the same time, I think that technology can be used into the crypto. So I think with more institutions coming into the market, they will bring in more advanced technology, more mature technology, and will in turn help the whole pie.
I want to talk about something that institutions or traditional financial institutions are very au fait with. And my personal opinion is that maybe in crypto we're missing some of it, and that is sophisticated instruments, options, derivatives, etc. Do you think that crypto has enough sophisticated instruments to lure the institutional investors? The reason why I ask is I spent some time with a fund manager who manages in excess of $1 billion worth of traditional funds, and said to me, you should really start looking at how you're going to trade Bitcoin when your fund eventually trades Bitcoin one day. And the first thing that he asked me, he said, are there enough options for us to trade? Are there enough sophisticated instruments for us to get involved in this game? Where are we when it comes to these sophisticated instruments?
There's certainly a sequencing to liquidity and the sophistication of it, and you need a borrowing market to have a futures market. So last year, I think we saw the surge of the ability to borrow, some different institutions that would lend. Then you saw the futures market come about. Then this year, you've seen the resurgence of the options market, vanilla puts and calls. We've been working to bring the exotics market. It's hard to have exotic options like binaries, variance swaps,